Well, hello, everybody, and welcome to another episode of our Southern California housing market update. My name is Stephen Meade with Domicile Real Estate for people who love houses. We are glad to have you with us. This is for January 31st, 2023. And, I don't always enjoy being right, but I'm going to go ahead and say it. I told you so. If you are a buyer who has been sitting on the sidelines, you're not going to like this. If you are a seller who was afraid that the spring might be brutal, well, this might be better news than you are expecting. I don't want to waste any time on this other than to say it is especially frustrating when you give people advice about the dangers in waiting or not waiting and they don't listen to you. And then they come back and they feel really bummed out because an opportunity they had is now gone. And I feel like that is going to be the case for some people who have been waiting, unfortunately. Anyhow, let's get started and dive into it. What is going on? Why is the market really kind of changed directions on us again? So let's go ahead and we're going to break out the numbers. And let me back up here. All right. So really, we've got a bunch of things and they're all saying the same thing. So when we have a bunch of different indicators and they are all kind of pointing in the same direction, that really says a lot about our market. So again, this is for Los Angeles and Orange counties. This is our total active listings index. These are homes that are active on the market, available to purchase. We have under $1 million and then $1 to $2 million to kind of segment our pricing here. And if we look versus a year ago, right, a couple things. Are we above where we were a year ago in terms of inventory? Yes, we have more inventory than we had February 1st. So that's some good news. I think you could say if you're a buyer out there. Unfortunately, it's not really that much more inventory, and February 1st of 2022 was really a low point in inventory. It was, saying we have more than that is like saying, well, if you had one listing and we have 50% more listings, we now have 1.5 listings. It's not really saying a lot. But what's kind of really interesting here, and the story is, in our under 1 million category, we have actually seen a drop in inventory since 2 weeks ago, right? That's unusual. If you look back here as the spring, it kind of starts off slow and then accelerates through kind of April. That's usually what happens, a gentle curve, and then sometime in March or April, things pick up. We've actually gone down from our low point, which was right around the first of the year, and we've hit a new low point in our under 1 million category. That is strange. That's unusual, and I think that is a bit of a harbinger of things to come. If we look here in our $1 to $2 million category, things are a little bit better, but they still dropped. Inventory dropped over the last 2 weeks. That's strange and unusual, and we're going to see why in a second. And we are almost again at that sort of level we were at the beginning of the year. So this year is shaping up to not be like last year, and I feel like at least at this juncture, those sort of expecting a big swell in inventory this spring, something we have not had in years past, really, I don't think it's going to happen this year either, not unless some fundamentals change drastically. So why are listings not going up? Well, this tells a little bit of the story. This is new listings coming on the market, and we are way down versus this point last year, right? This point last year, we had about 2,500 new listings coming up in the trailing 2 weeks in under 1 million category. This year, we are below 2,000. Last year, we had a little over 1,000 $1 to $2 million listings hitting the market in the trailing 2 week period. This year, we are below. But what's even more concerning is the shape of these graphs, right? We hit this low point. We got a swell of listings that had been waiting on the market, right? And then they just kind of petered out, and we're just not getting any momentum for new listings hitting the market, at least not in the last 2 weeks. That could obviously change. I think when maybe some sellers see that things aren't as bad as they thought, the rates are a little lower than they thought, maybe that will spur some more listings, but really, this is incredibly unusual. But what's the flip side? Let's look at new escrows. So are we down versus last year? Yes. we do not have as many new listings, but look at the shape of this curve. Last year, things were pretty flat, maybe kind of a gentle growth, and then they kind of went down as the year went on, as interest rates went up. This curve is very differently shaped, and it follows us into that 1 to 2 million category too. We are at the level of new escrows hitting the market, the same level that we were at back in October. That's where we are. So, and this doesn't show any signs of really abating, right? This number is going up, it's shooting for the moon. The real question is, when is it going to start to flatten out? Are we going to exceed where we were last spring? We might. Same thing here on our 1 to 2 million. It is shooting for the moon, maybe not quite as steep of a curve, but really this is rather dramatic. And if you look, where are we again? We're back to this end of September, beginning of October sort of demand level in the market. And guess what? It doesn't take a genius to realize if new listings have petered out and new escrows are going up, what is that doing for our absorption rate? Again, we saw this peak when there were buyers out there and no new listings. It dropped with the swell of new listings, and then wow, it is shot right back up over 90% here for our under 1 million. That is in sort of near circus level territory for these under $1 million houses. And then even our 1 to 2 million category, these are healthy numbers. These are very healthy absorption rates. What does this mean? It means that, especially under $1 million, if 10 new homes came on the market, 10 homes went into escrow that week. Really, we're close to 100%. Now, you might get some hope here if you're looking at these closed prices, but you have to remember these closed prices are based on 4 to 6 weeks ago, right? And what do we see? At the high end of our market, we're down a little bit, right? We jumped up, then we jumped down. We'll call this a very gentle downslope. Again, a very, very slight gentle downslope for our median, and then a little bit of a downslope here after a little bit of a rise, here in our entry-level price segment. I think in the next 4 weeks, you're going to see these reverse. With this kind of absorption rate, there's no way that prices don't move upward to some degree. Here's another sign of a changing market. So if you look back all through 2022, right, we saw this percent still active after 14 days kind of steadily going up. What did that mean? The market was getting less and less competitive. Then we kind of reached this point towards the fall, and it really kind of eased out. But look what has happened since the beginning of the year. These aren't just a little blip going down. These are sustained downward trends for both our under 1 million and our 1 to 2 million. Yet another sign that the market has hit a bit of an inflection point. Yet another sign pointing to that, our close to list ratio has reversed trajectory. So again, if you look at this, all through the spring, we were flying high, well above list price, way above list price for those high dollar listings. Then we started to hit right around the end of June, beginning of July, we started in on our 2%. And then once we got into August, we were trading right on average. Listings were selling what they were listed for. And then that deteriorated further through the fall as those high rates. And then look what happened at the beginning of the year. We essentially changed course and reversed directions on this, with this heading back upward. We are now back up for our under 1 million, heading towards maybe 98.5%. That's still in what we're going to call the normal range, but I don't think this number is done going up. And we are just over 97.5% here for 1 to 2 million. It bottomed out and bounced up. We might need another sort of update to see whether that's going to hold true. But given the rest of this data, I think everything points to homes selling for a higher percentage of their list prices in the future. Then if we look at days on market for new contracts, right? What did we see happen here? 20 days, 20 days, 20 days. And then once we got into June, things started going up. They really accelerated here through the fall. And as we went in, they kind of peaked here right around that 55-day mark for both under 1 million and 1 to 2 million. And then they started taking a dive. Now, under 1 million is leveled out a little bit, but looking at the rest of the numbers, it's going to continue a downward trajectory. Part of this is normal, right? We see this pattern, right? As we go to the spring, days on market goes down. Over the summer, it bottoms out, and then it starts heading up into the fall. That's pretty normal, but this is a pretty dramatic change to see this. Again, another sign that our market has hit an inflection point. Now, one of my favorite graphs, right? The three-way, where we look at our payment index, our CPI index, and our rent index, right? And just to give people a little bit of insight, I'm going to explain what these numbers are once again. The payment index is we basically look at the median priced home, we look at the prevailing 30-year fixed rate interest rate, and we impute a payment and we index that back to June of 2018. Then for our rent index, we take a look at the rent of the median single family home in LA and Orange counties, right? We do that on purpose, right? Because that single family market is going to be a lot more closely tied to home buyers, right? As an alternative. So we take a look at that and we compare how those have grown over time. So jumping back into this, look at what we've got going. Again, so if you look back here, we go all the way back to June of 2018, which is what we've indexed everything back to. We see that, really these numbers, as we went through 2022, we saw wider, then things narrowed up and they got some stability, right? Because if this rental index and payment index get really far apart, what happens? People stop buying and they move towards the rental side of things, right? If these get too out of whack. Now, if the payment index drops, if the reverse happens, if the payment index drops and the rent index keeps going up, people are going to stop renting and they're going to move back towards buying, right? We see that trend. So kind of a measure of market health really is to sort of watch this relationship and the gap between these 2 points. And what we see is there was kind of a widening gap here. This is when the market really slowed down. Shocking news, right? Rents actually slipped. But what's happened is rents have actually started to go back up again. We are almost now back up at that same level we were over the summer of last year. And in the meantime, the interest rates have eased a little bit. What has that done? It's closed this gap to somewhat of a manageable level. And this is a gap that I feel comfortable with as a point of market stability, right? It doesn't mean people are flocking in big numbers. They're not going to stop renting or start buying or stop buying and start renting, right? We're seeing this as kind of a place of stability. We don't have our numbers yet for our CPI for January. Those numbers will come out in the middle of February, so we will update our graph then. And then we finally have our prevailing mortgage rates. And as you can see, they peaked just kissing 7%. And really that occurred right about towards the end of October. And now they've been steadily moving back towards that 6% level. I know a lot of economists are talking about 5.5% as sort of this magic number where demand will go crazy again. I'm not sure I put a lot of stock in magic numbers like that, but I think we've definitely seen as these rates have eased off the 7% mark, the buyers have both gotten used to higher rates and been relieved that they've moved in the right direction. And I think a lot of buyers have come back into the fold. Well, that is all I've got for you this week. I hope you're having a great week so far. As always, questions and comments, we love those. If you are looking to buy or sell residential real estate in Southern California, specifically Los Angeles and Orange counties, we would love to lend you our expertise. Definitely reach out to us. Don't forget to like, subscribe, and hit that notification bell. And we will see you again real soon.